Good evening and welcome to the latest Hutchings Consultants webinar, a step-by-step guide to selling a pharmacy. My name is Paul Steet and I'm a Senior Pharmacy Consultant at Hutchings. And today I'm joined by my colleague, Mr. Atif Butt, Senior Accountant at our sister company Hutchings Accountants, and Mr. Tim Jenkins, Partner at well-regarded law firm Charles Russell Speechlys. Both Atif and Tim have an enormous amount of experience in their respective fields, which are focused on the pharmacy sector, and are well placed to provide their professional help and guidance during what can be for many a daunting prospect when considering selling a business. Our presentation this evening is designed to take you through the steps involved in selling a pharmacy and to cover, as best we can in this short period of time, the process involved and the pitfalls to avoid if possible. Before we begin, there is a housekeeping point I'd just like to mention. At the end of the presentation, we will be answering questions. So if you'd like to send in a question to any of the participants, you can do so by clicking on the right-hand side of your screen, which will open up a message box. If you then type a message and click send, that will come across to us, and we will endeavour to answer this for you once we have concluded our presentation, if time allows. Don't worry if we don't answer a question you've sent in, as we will respond to you in the coming days. Hutchings Consultants are the largest pharmacy-only agent in the UK and have been approved and recommended by the MPA since 2005. We have an excellent reputation within the sector and are very clear we only work for you, the seller. Overall, we feel this provides us with a wealth of experience and knowledge in order to assist you when it comes to selling a pharmacy, and enables us to provide you with an insight on current factors affecting the market. I'm sure as a pharmacy owner and potential seller, you will be interested to understand what is happening in the market currently. In terms of the values achieved, pence in pound figures give a broad overview. And you will see from this slide that since 2017, the average figure has decreased across the United Kingdom. The cumulative impact of the various government-imposed funding cuts have taken their toll on the market, although it usually takes a while to affect prices, as there is a delay between when the cuts are imposed and for the resultant impact to be seen in the trading accounts. As you will see, the figure for 2020 to date shows an average of 84p, although please bear in mind that within this data, there will be sales which will have achieved in excess of this and vice versa. As you might expect, there is a diverse range of prices around different parts of the UK, as pharmacies sold in Scotland and Wales have generally achieved higher pence in pound figures than those sold in England in recent years. This is mainly due to the perceived increased government support, which has maintained high buyer demand in a market short in pharmacies available for sale. In the last 12 to 18 months, we've experienced a notable increase in the volume of pharmacies coming onto the market, as the multiples and larger groups have sought to offload some of the less profitable shops. Many of these opportunities have been either breaking even in terms of profitability, or have been simply trading at a loss, which has enabled first-time buyers a chance to secure a pharmacy, but has had a resultant downward pressure on prices. This news may leave you feeling that the market has stalled and your chance of selling is low. However, it's true to say that this is definitely not the case. Even during the period of lockdown, we've experienced a high level of activity from buyers, which has been very encouraging to see. Since the beginning of January this year, we've seen a big increase in the number of new buyers registering with us to date. During the period from March to August this year, we have registered 87% more buyers compared to the same period in 2019. Many of these have been keen first-time buyers, but we have also seen an increase in existing pharmacy owners and regional group owner registrations, as well as investors from outside of pharmacy, which is a positive signal moving forwards. We've also seen an uplift in the number of buyers making an offer per pharmacy, which as a seller you want to encourage, as this creates a competitive environment and provides the best opportunity for your agent to negotiate the best price and terms when selling. The major banks are still very supportive of pharmacy, and several appear to have a strong desire to heavily increase their lending to the sector. although we understand credit and underwriting teams across the board are taking a long, hard look at all borrowing applications presented to them. They are also asking for high deposit contributions from the buyer in order to increase their security. But in the main, there is definitely an appetite to lend. An area which remains of concern, though, is the NHS England market entry process for fitness to practice and change of ownership applications. Whilst there was an inevitable slowdown as a result of COVID-19 on employees' ability to work, we continue to experience long delays, which is having a knock-on effect to sale timescales. There appears to be a gradual move across to an electronic process from the current paper-based application, which is hoped will have a positive impact on timescales. Our advice to clients is that the applications should be submitted as soon as possible where relevant. To demonstrate the buoyancy in the market, I wanted to quickly show you two examples of sales we've agreed in the last few weeks. For confidentiality reasons, I'm not at liberty to disclose too much information at this stage, but this first example is a pharmacy based in Yorkshire, with a turnover in the region of £500,000 and dispensing an average of 4,745 items per month. Following a period of marketing, we received a total of 15 offers from 8 parties, and eventually accepted an offer in excess of the marketing price. What is of particular interest in this case is that 4 of the 8 parties who offered were 100% cash buyers, further demonstrating the activity in the market currently. A deposit has been exchanged, and we are now proceeding with the legal due diligence. The next example is a pharmacy based in Hertfordshire with a turnover in the region of £760,000, dispensing an average of 6,584 items per month. During the offer process, we received 11 offers from 5 parties and also agreed a price in excess of the marketing price. Now I'll move on to the various steps of taking a pharmacy to the market, accepting an offer, and moving into the legal due diligence process. Step 1 is the specialist valuation. In today's market, where there is a high level of competition with other pharmacies available for sale, it is more important than ever to ascertain and understand what the correct marketing price for your pharmacy business is. It can sometimes be a fine balance, but if you go to the market at too high an asking price, you run the risk of deterring buyers, which will lead to a low level of interest. But if you start too low, you risk underselling and not being able to achieve your intended objectives. You then may have offers below expectation, which could mean you're either forced to remarket or cease marketing altogether and postpone your plans. In order to fully understand your business and be able to recommend an accurate marketing price for you, a competent, experienced agent will need to gather in your financial information to undertake a valuation. At this stage, we usually request the information as you see here. There may be additional information we require depending on your particular pharmacy, but the more information we have at this stage, the more accurate we can be with valuation. This will reduce the risk of you being disappointed when offers are called in. As part of the valuation, we review the information you have supplied and establish an EBITDA figure via an adjusted profit and loss. A multiplier is then added to the EBITDA to calculate the value. The multiplier figure varies according to many factors, but the key decider is based on our extensive experience in the marketplace. When it comes to determining the value of a pharmacy, there are many factors an agent needs to consider. This slide shows some of those factors, but there are many more not mentioned. While some of these factors, such as on-post and private scripts, will have a definitive monetary effect on value, others, such as the level of competition in the local area or business potential, are perhaps a little harder to define, but nonetheless need to be taken into account when finalising the valuation. We are sometimes asked to provide a valuation on very limited information, such as just the turnover or item numbers, which isn't really advisable as it can lead to misleading figures. A professional agent will require a certain amount of information from you in order to understand the business and provide you with a valuation which is worthwhile. Most sellers, understandably, want to achieve the best price possible when it comes to selling their pharmacy. As a business owner, you have invested over the years a huge amount of time, emotion and money, not to mention enjoyed the associated stresses of running your own business. And it's important that you feel rewarded for this once you hand over the reins to a new owner. As we have just seen, there are a huge number of factors that affect the valuation, and many owners ask us how they can increase the value of the business in order that they may plan ahead and focus on these areas. Again, whilst there are a multitude of factors that could be mentioned, there are perhaps 4 key areas which we tend to focus on, as they can have some significant implications and affect the saleability of the business. Gross profit percentage margin is at the forefront of many buyers' minds when reviewing a potential opportunity. An average margin currently is around 30 to 32%, although again this will vary greatly in different parts of the UK, with London pharmacies still demonstrating the highest margins. Many of our clients advise us they are now spending a greater amount of their working time researching the best buying prices, or have even tasked a member of staff with this role where capacity allows them to do so. An improvement on the margin should eventually result in an improved EBITDA figure. Working hard to improve your margin will be time wasted if you allow your business expenses to run out of control. Keeping tight control on costs is obviously of huge importance when running a business, but becomes even more so if you're planning to sell. Both buyers and their accountant will want to undertake financial due diligence, and your profit and loss will be scrutinised. Staff pay increases and bonuses, for example, will affect your bottom line, and if ongoing, will potentially impact on your final sale price, particularly if these salaries are above accepted industry norms. We've had instances in the past, for example, where a client has wanted to reward a member of staff and agreed a significant ongoing staff bonus as part of a salary review without realising that this would impact the price they can achieve when they come to sell. I'm certainly not suggesting that staff shouldn't be rewarded, but just bear in mind that increasing your costs will impact on your bottom line profitability. Although there is a swing across to a more service-led NHS remuneration contract, the volume of items a pharmacy dispenses is still likely or still key to both turnover and saleability. Most buyers are attracted to a pharmacy which can demonstrate increasing numbers, and therefore this should be a focus for you as part of a plan to sell. Finally, pharmacies operating on a leasehold basis should ideally have 15 years remaining on their lease at the point of going to the market. The banks will usually match the term of the buyer's loan with the term remaining on the lease. If you have a lease of less than 10 years, this could be an issue for a buyer obtaining affordable finance, particularly if they're a first-time buyer with no trading experience, although a buyer with more assets and an existing owner may find it a little less problematic. Therefore, your lease should be reviewed, and if there is less than 10 years remaining, consider extending it if possible. But speak to your selling agent before doing so, as they should be able to guide you on the best strategy around this. So step 2 of our process is the confidential meeting. This is an opportunity for us to meet you and spend some time understanding your objectives and any concerns you may have about selling. The meeting normally takes place once your staff have left for the day and will allow us uninhibited access to view the premises. Alternatively, if this isn't possible for any reason, if you prefer, we can conduct a mystery shop and meet you off-site at a suitable venue. At the meeting, we discuss and agree the marketing strategy, which we will try and tie in with any points from the conversation and objectives you may have. It is also a further opportunity to discuss any queries you may have generally or specific to your situation. We then move on to the next step, which is preparing the sale literature. Our sales brochure is designed to be eye-catching to potential buyers, as you need to attract their attention quickly, particularly when they will be receiving brochures on other opportunities. The information we disclose focuses on the most salient points demonstrating profitability and potential. The key is also to provide sufficient information at an early stage in order to reduce the volume of questions the buyer may ask. We only start the marketing once you, the seller, have approved the document and are happy to move forwards. A confidential listing can be added onto the Hutchings website, taking care to avoid disclosing the exact location of the pharmacy for sale. In addition to this, we prepare a separate financials pack, which includes the accounts, FP34s, VAT returns, OTC figures, and a copy of the lease if applicable. As part of preparing to market a pharmacy, we dedicate a large part of our time researching and identifying potential buyers we wish to contact. This research will consider factors such as who is currently active in the market, do they have sufficient funds available, previous experience with a buyer, buyer's criteria and ethos, their geographic location, etc. Only potential buyers who have registered with us formally and signed our non-disclosure agreement are contacted. We remind buyers throughout the process to need to keep the sale confidential. We consider each pharmacy as an individual sale and tailor the marketing approach accordingly based on the business's unique factors. Our general approach is to create an initial shortlist of the best buyers taken from our database of several thousand registered potential buyers. The selected parties will initially receive the memorandum of sale, and if they have a further interest, they will then receive the financials pack. These parties are followed up for their feedback, and where suitable, viewings will be arranged at a time to suit you. Each viewing will be followed up and feedback provided to you. In order to provide the greatest opportunity to secure the best price and terms for our client, we use our experience to market the business and attract interest. The period of marketing where viewings take place is around 6 to 8 weeks on average, although as each pharmacy sale is different, this can sometimes be shorter or longer, depending on the circumstances. Hutchings has a tried and tested structured offer process which we've applied over a number of years. Occasionally, we may recommend to the seller that they consider an individual offer on an ad hoc basis, but in the majority of cases, once we are at a stage where it's appropriate to call in offers, in agreement with yourself, we invite interested parties to submit their indicative offers in writing by a specific date. We use a template offer which avoids misunderstandings as to what is being paid, particularly on the more complicated share sale route, which is vital. As part of the offer letter, we request proof of funds and also the parties' agreement to pay a security deposit of a minimum £20,000 if their offer is accepted. Shortly after the initial round of offers, we move to the best and final offer round, which enables buyers an opportunity to improve and fine-tune their first offer if they wish to do so, once they've received limited feedback from ourselves. The 2 rounds of offers help create a competitive environment between buyers, which allows us to negotiate the best price and terms possible. Once an offer is accepted, we then move into the legal stage. I won't go into too much depth about this stage, as this will be covered in more detail by Tim and Atif shortly, but we arrange for the deposit to be paid to and held by your appointed solicitor. The deposit is held in accordance with a deposit and exclusivity agreement that both you and the buyer sign, and in exchange the buyer receives a period of exclusivity, whereby other potential buyers are excluded from making an offer. We then issue the heads of terms confirming the sale to you, your buyer, and both sets of solicitors and accountants. Our role as an agent now changes from one of marketing to that of sales progression, as we liaise with all parties during this period to ensure the transaction is progressing forward. Once an offer is accepted, an average timescale to reach completion is around 4 to 6 months. However, there are many factors that can affect this and impact the sale significantly, such as COVID-19, bank delays, NHS fitness to practice and change of ownership applications, and lease issues, to name but a few. There are several key do's and don'ts to mention when considering selling, which you should be aware of, and will help you avoid timely delays, which could ultimately jeopardise your sale and create undue stress. Firstly, do plan ahead your exit strategy. You may feel you're not yet at that point of selling, but the earlier you start to plan and prepare for a sale, the greater your chances of securing a better price and achieving a smoother transaction. Recent changes in HMRC regulations, which Atif will cover shortly, could mean that you are prevented from selling for 2 years if you want to avoid incurring a hefty tax bill. You should consult with your accountant to understand what is the most tax-efficient sales structure for you, as this will depend on your business and the assets held. You can then discuss this with an experienced agent who should be able to advise you on how you should prepare and highlight any areas you may need to address in order to ensure as smooth a sale as possible. Put your house in order. This ties in with planning your exit strategy, as the earlier you address potential issues which could delay a sale, the better. For example, you may need to renew leases, move assets out of a limited company, put staff contracts in place, or deal with tax issues, which in most cases you are best advised to deal with before a sale begins. One area that comes up fairly regularly is where a sole trader has incorporated, perhaps many years ago, but never advised the NHS, and both the contract and FP34s are still in their previous trading name. If selling the limited company, these need to be switched across into the company name, which can involve you having to submit fitness to practice and change of ownership applications to market entry. As we see currently, this can take many months to complete, and it is wise to start the process as soon as possible to avoid any delays. Do appoint professional advisors who have pharmacy sales experience. In order to ensure your sale progresses as smoothly as possible, it is vital that you employ professional advisors who have proven experience in pharmacy transactions. This is a niche area of legal and accounting expertise, and therefore don't assume your usual high street solicitor or accountant have the necessary ability to advise you. We have certainly seen sales fall through at a significant cost to the seller as a result of an advisor's lack of understanding, which has created issues difficult to overcome. Indeed, only recently we had a solicitor acting for a client disinstruct himself halfway through the legal work as he realised it was outside the scope of his ability. Lastly, once you have found a buyer, don't be tempted to relax and feel that you can sit back as the sale goes through. Both the buyer and their lender will keep a close eye on the business performance as the sale progresses, and you don't want to allow the buyer an opportunity to reduce the price if there's a fall off in trading figures. Only once you've completed can you finally take that foot off the pedal. So that concludes my part of this evening's presentation. But before we move over to Tim and Atif, if you feel ready to take the next steps towards selling, please contact either myself or one of my colleagues to discuss how we may assist you. We can offer a free verbal valuation and a free tax review. We can also arrange a confidential meeting to discuss how we can help you further. Many thanks for listening, and I will now hand you over to Tim and Atif.
Thanks, Paul, and hi everyone. My name's Atif Butt, and I'm the Senior Accountant at Hutchings Accountants. We've been specialising in pharmacy sales for over 30 years, and today we're going to run through a step-by-step guide to selling your pharmacy and how you can get the most out of it. I'll be focusing on accounting and tax matters, and we'll be joined by Tim Jenkins, partner at Charles Russell Speechley Solicitors, who also specialises in pharmacy sales and will be talking through the legal aspects so you can get a comprehensive idea of what you need to be thinking about and when. Today we'll be talking about preparing for the sale, due diligence, pre-sale issues, the legal process, completion, the completion accounts, and what happens after completion. Let's start by talking about the first step, preparing for sale and understanding your tax position. If you're thinking of selling your business in the future, it's never too early to start getting ready, even if you don't plan to sell for many years. Being properly prepared can make a huge difference in not only the price you eventually get, but also how much you're left with to maintain your lifestyle in your retirement. This has never been as important as it is now, with a number of risks and uncertainties facing the pharmacy sector and beyond. Some of the current issues we're facing are as follows. We've all seen how the COVID-19 pandemic has changed our lives in a way that would have been unimaginable at the start of the year. As we've seen further restrictions announced across the country today, it's clear that this is something that will continue to have a huge impact on all aspects of our lives for the time being. At the same time, we still don't know how the ongoing Brexit negotiations will play out and what effect the eventual deal or no deal will have on the economy. The prospect of less regulatory alignment with Europe also means the UK government will be freer to make changes to our laws. We're also likely to see changes in tax rates and reliefs coming in the coming years. Following the lockdown, the Chancellor has admitted the UK economy is facing an unprecedented challenge, and the government needs to find new ways of increasing its revenues. We've already heard that the Chancellor, Rishi Sunak, has commissioned a review on capital gains tax, and this is an obvious target for reform as it's currently charged at much lower rates than income tax. The government made significant changes to entrepreneurs' relief recently, which I'll talk about later, and it's possible we may see further changes to come, or even the relief being abolished completely. What about the future sector and market conditions for independent pharmacy? Paul's talked about the current state of the market and how it's been affected by current events, but as we've seen, there are a number of factors that can change things significantly over the coming years. Of course, it's impossible for us to predict what's going to happen now and in the future, but the best way to manage these risks is to be prepared. Once you've decided you want to sell your pharmacy, be sure to get specialist advice that takes your individual circumstances into account. This will help you work out the best strategy for the eventual sale, having considered the accounting, legal and marketing perspectives. At Hutchings Accountants, we review your accounts and tax position to recommend the most tax efficient way to proceed. Getting the structure of your sale right can have huge tax implications that could make a difference of hundreds of thousands of pounds to your tax bill. And it's important to look at this as early as possible, as it sometimes involves making changes to the business. If your pharmacy is trading through a limited company, the first thing we look at is whether you should sell through a share sale or an asset sale. Here's Tim Jenkins from Charles Russell Speechlys to talk about both options. Over to you, Tim.
Thanks, Atif. So, as Atif mentions, if your pharmacy operates through a limited company, you do have a choice in terms of exit strategy, either to sell the shares in your company or for the company to sell the assets of the business. If you operate your pharmacy as a sole trader or a partnership of pharmacists, then it will be the asset sale route that you're looking at. But if you're a corporate operator, as I say, you do have a choice. I thought I'd just briefly compare and contrast both in high-level terms. So with an asset sale, there is a change in operator of the business. There's a transfer of the assets and the contracts that support the business. And if you're an NHS dispensing pharmacy, then NHS England, if you're an English pharmacy, or the NHS in Wales, if you're in Wales, their consent is required, as Paul's mentioned, under the market entry process before the sale can be completed. Additionally, most pharmacies will have some employees, and there is a requirement in law to consult with the staff prior to the sale being completed, where you're undertaking an asset sale, because there will be a change of employer in relation to the staff, who will generally have a right to have their employment transferred to the buyer with the business. And there may be other third-party consents needed. So if you're operating a leasehold pharmacy, the likelihood is that the terms of your lease will require the landlord to give its consent before the lease can be transferred into the name of your buyer. There's less buyer risk, if that's the right word, associated with an asset sale, in the sense that where there is an asset purchase, the buyer won't generally inherit responsibility for the way in which the business has been operated historically. It's only responsible for what goes on on its own watch, so to speak. But there is more to do logistically with an asset sale, as hopefully that gives you a flavour, particularly around the consents, and it may take longer, most notably, as Paul has rightly flagged, the fact that if NHS consent is needed for the transfer, then that is likely to be the consent requirement that takes the longest to be satisfied. Contrasted then with a share sale, if you're a corporate operator, in this situation, there's a change in the ownership of the shares of the company, but the company remains the operator of the business. So some of the points that I've raised in relation to asset sales will not be of relevance. Generally, third-party consents, therefore, won't be needed, whether that's NHS or landlord, provided that your lease and your NHS contract are in the name of the company. And Paul's quite right to flag that that's something to check at an early stage. We've also seen instances where they might be in the name of the shareholder rather than the company, and that can take time to sort out, as Paul said. There's no legal requirement to consult with staff if there's no change of employer. That said, obviously vendors will still want to let the staff know of their plans, but the point is that there isn't a formal process that has to be followed there. So there's less to do logistically, and potentially therefore it is a quicker process. There is more buyer risk in the sense that the buyer inherits the company and its trading history, so there's a little more in the way of due diligence for the buyer to get through. But I should add that that's by no means seen as a barrier to sale under the company share sale route. Pharmacies have been in operation through companies for many years, and most buyers are quite comfortable with the concept that they may be looking at a transaction that needs to be dealt with as a company share sale, and they will just simply get through the due diligence process in return for that. Finally, one of the main considerations beyond the points I flagged in terms of choice of share sale or asset sale comes down to the tax position. And on that note, I shall pass back to Atif to talk a bit more about that.
Thank you, Tim. Now, to decide on the right structure for a company sale from a tax point of view, we would calculate what your estimated tax bill would be from each option, as there's a considerable difference in the tax treatment. A share sale means you'll be taxed personally on the gain and pay capital gains tax. An asset sale would mean the company selling the business and paying corporation tax, and you're being subject to a further personal tax charge when you take out the profits. If you are considering a company share sale or personal asset sale, you may qualify for Business Asset Disposal Relief, or BADR, formerly known as Entrepreneurs Relief. Business Asset Disposal Relief is a relief that can apply when someone sells part or all of their business, and means you only need to pay tax at a rate of 10% on the gain if certain conditions are met. Each individual has a lifetime limit of £1 million worth of gains that can qualify, which has been reduced from £10 million. In a share sale, the qualifying conditions are that you need to hold at least 5% of the shares and voting rights and be either an employee or officer of the company, which must be a trading company. These conditions have to be met for at least 24 months before the disposal. So, without BADR, if you were to sell your business for £1 million, you would be liable to capital gains tax at 20%, which is £200,000. But if you qualified for BADR, this could be reduced to 10%, meaning you'd only need to pay £100,000, which is a huge tax saving. Now, there are circumstances where you may not qualify for the relief. For example, you're trading through a limited company which also owns investment assets such as shares or properties, and which has a high level of cash at the point of sale. It's important to identify any problems as early as possible so you can take the necessary steps to remedy them. If you are considering selling your pharmacy in the next few years, we recommend you take advantage of our roadmap to sale service, which is aimed at pharmacy owners who'd like to increase the business's value before they sell. Using an initial valuation of the business, we identify the key performance indicators affecting the value and look at how these can be improved. We also look at any issues picked up in our review of the accounts and tax position and work out the steps necessary to resolve them to ensure you get the most favourable tax treatment when the time comes. Finally, we map out a list of prioritised targets we want the business to achieve and a timeline over which we want to achieve them. This can be things like reducing stock holding and wastage, improving the gross profit margin, reducing staff costs, and making sure the sale will qualify for business asset disposal relief. As part of our roadmap to sales service, we use customised management reports to analyse and monitor the business's performance each quarter and ensure it's still on track to meet its targets for improvement. During this time, we also use the management reports to compare the pharmacy to similar pharmacies in a process called benchmarking. This can be very useful in providing insights about things we're getting wrong or right. These management reports also help us look at how the potential market value of the business is changing as time progresses based on the most recent performance, so we can verify whether the numbers are moving in the right direction. Twice a year, we review the results and reevaluate our plan where necessary, and that way we can also factor in any changes in circumstances and revise our targets and timeline accordingly. The aim of this process is to increase the value of the pharmacy as much as possible before it's put on the market. And it's important to remember that every £100 spent on getting the right professional advice and input can increase the profitability of your business by thousands of pounds, which in turn can increase the value of your pharmacy by tens of thousands. Now, let's talk about what happens once you've found a buyer. The next step is the due diligence process that Tim mentioned earlier. Once your potential buyer pays their deposit, the due diligence process gets underway and the buyer's accountant requests a list of information. In a share sale, they're likely to want to go back over several years so they can be as comfortable as possible about the history of the company. Let's go back over to Tim to tell us a bit more about this and how you can prepare for it.
Thanks, Atif. I thought I'd start just with a few property points, which are relevant whether you're looking at an asset sale or a share sale. If you have premises from which the pharmacy obviously will be operating, freehold or leasehold, there are some basic reports and certificates that will need to be provided. Energy performance certificates, which I'm sure most of you will be familiar with. Those have been law now for several years. Electrical safety and PAT certificates, asbestos management reports, to name a few. So it's worth making sure that you've got those to hand alongside your property title deeds. If you're operating from a leasehold pharmacy, as Paul has already flagged, it's worth doing a pre-marketing lease audit, in particular to check the length of the lease, as Paul has said, but also equally importantly, its renewability when it expires. And a point that we've both alluded to, check that the lease is in the correct name. In terms of lease length, as Paul has said, buyers will typically be looking for anything from 12 to 15 years unexpired and ideally with the right to renew at the end of that time. It's also worth bearing in mind that there will be potentially landlord consent requirements that may impact on the logistics for the legal process of sale. I've mentioned landlord consent when there's an asset sale for the transfer of the lease, but also on a share sale. It can crop up. Sometimes we see consent requirements if you have a lease within a health centre, for example. And indeed, if the lease has a requirement for landlord consent before the property lease can be mortgaged, then that may be relevant if your buyer is looking for a mortgage to support the acquisition finance. So it's worth checking all those points and being prepared for those. Beyond property, some commercial points which tend to crop up as part of the legal due diligence phase, again, in the main, whether it's asset or share sale transaction. Your arrangements with your staff are obviously key to the business, therefore being able to provide not just the key information in relation to the staff in terms of job roles, hours, pay rates, etc., but also have they got employment contracts, is there an employment handbook, employment policies. There are some fairly mature documents that tend to be provided by lots of providers nowadays to assist with those, but it's worth making sure that you've got those together and they're available to share with the buyer. And alongside that, pension documents, workplace pension scheme arrangements affect pretty much every pharmacy now. So you ought to have your declaration of compliance, auto-enrolment documentation, as well as information around contribution rates and so forth. Commercial contracts also worth thinking about, particularly in terms of insurances and the contracts that support your IT hardware, software, including the finance agreements if those are on rental, as well as the support arrangements. And it's worth giving some thought to what the renewal dates might be on those contracts, particularly if those are coming round within the next few months in which you're looking to complete the sale. And it may be that the purchaser would like to see them renewed. It may be the purchaser's comfortable that not renewing and the purchaser being able to move to their own provider is of more convenience, but it's worth having that in mind. Business records are another obvious one. Purchasers will want to see employment records, VAT records, the pharmacy compliance records, making sure those are all up to date. And if it's a company sale, it's also worth giving some thought to whether you as the shareholder directors have given any historic personal guarantees for the company's commitments, for example, to a landlord on a lease, or to the bank on finance, or maybe finance leases if you have anything of that nature. The important point being that those aren't generally automatically released just because you're selling your company, and therefore it may be that we need to be looking to ensure that those are released as part of the logistics for completing the sale. And then the final point, just to touch on again, has been spoken about already, but checking the registrations, in particular that the NHS contract's in the right name, but also the GPHC premises registration is another key one for the buyer. With that, I shall pass back to Atif.
Great, thank you, Tim. Some really useful things to think about there. Now, as we've said, preparation is key, and it's worth looking in a bit more detail about some of the pre-sale issues, we commonly see in pharmacy share sales that can cause problems or indeed present opportunities. We talked earlier about the conditions for business asset disposal relief. If you have a company with more than one share class, this may need to be looked at, as some of the shares may not qualify for the relief at present. Your company also may not qualify if it owns too many investments or holds too much cash, as HMRC would no longer consider it to be just a trading company. So this is also something that needs to be looked at and care taken to make sure there aren't any issues. The level of cash can have other implications, which Tim will talk about later, together with directors' loans and how they can be dealt with in a transaction. Investment property owned by a company can cause problems with business asset disposal relief, but we more commonly see pharmacy companies that own the trading premises they operate from. Sometimes these are included in the business sale, but in many cases the business owners want to take them out of the company before the sale so they can give the new owners a lease and benefit from the rental income. Here's Tim to talk about some of the options in such cases.
Thanks, Atif. So this is actually a situation that we've recently come across on a transaction. So we have a company that runs the pharmacy. The shareholders also own the freehold to the building, but it's owned via the company. And the plan is for the company to be sold as a share sale, and the purchaser is going to take a lease of just the pharmacy within the building from completion, as the vendors want to hold on to the freehold as an investment and move it out into their own names before the sale goes through, which also suits the purchaser, as it doesn't particularly want to have the capital cost of having to purchase the bricks and mortar as well. So the classic question is, how can that be achieved? And there are a number of options for it, and I'm not going to dwell on them at too much length. I thought I'd just mention the three most commonly considered options. The first being extracting the freehold property out of the company into the shareholder pension scheme arrangements. That's a subject in its own right, so I'm not going to dwell on it in too much detail. The main point that I've mentioned there is to bear in mind that where capital assets are contributed to a pension scheme, they are generally locked up until retirement. So it's worth just bearing that in mind. The other options that I wanted to look at briefly, which we do see more commonly, is for the freehold to be transferred from the company to the shareholders as a form of dividend at so-called book value, which I'll come back to in a minute, or alternatively to transfer the property to the shareholders at market value by way of a sale. There may be some other variants to that. They tend to be tax driven, but looking at each of those briefly in turn. So the scenario that we had recently was precisely this situation, where the freehold to the building had been acquired by the company a few years ago for £180,000. Market value at the point of selling the company had risen by £40,000 to £220,000. So the question was, what do we do? Option one is the dividend route. So the company, if it has got sufficient distributable profits, which is an accountancy test, can declare a dividend equal to the book value of £180,000, i.e. the base cost that was paid for the property. The property then becomes owned by the shareholders, so tick in the box, it's been extracted. The shareholders don't have to pay for it, it's satisfied by the dividend. It's likely to be free of any stamp duty land tax, which is a property tax that can arise on property transfers. But there is dividend income tax payable by the shareholders on the value of the dividend. And in our case, it was particularly relevant as the shareholders were both high rate taxpayers with an effective rate of 38% for dividend income purposes, which on a property valuation of £180,000 as the dividend meant just short of £70,000 worth of tax. So what was the alternative? Well, the alternative is a transfer at market value. It has the same effect. The property is moved out of the company before the share sale proceeds. It's owned by the shareholders, box ticked. Market value is paid for the transfer. The transfer was made a few days ahead of the share sale completing. So the value of £220,000 as market value was just left outstanding as a loan by the company to the shareholders for a few days. They were then able to use the sale proceeds at the point that the sale of the shares completed to repay that loan to the company. The loan repayment was then added back to the final share price because it effectively is still money sat on the company's balance sheet at the point of completion, which goes towards the calculation of the final share price. So effectively, the arrangement had a neutral impact on the overall sale proceeds that the vendors received, and they retained the property. The point of contrast being that whilst there was still a tax charge for the sellers to fund with that arrangement, it was a lower tax charge. There was capital gains tax as both vendors qualified for entrepreneurs relief, which meant a 10% tax rate payable on that market value of £220,000. So a £22,000 tax bill there. There was a little bit of corporation tax because the company was selling the property at a gain. That was around £7,500. There was a little bit of stamp duty land tax to pay, but not a ground-shattering sum. So again, based on being high rate taxpayers, there was a considerable tax saving of getting on for £40,000 in difference. So hopefully that gives you a brief flavour of some of the options around that structuring question. And I'm now going to pass back to Atif.
That's great, thanks Tim. Another important area that is worth considering early on is what you want to take from the business in the form of salary, pensions and dividends in the years leading up to your sale. Tax rates on salaries and dividends are generally much higher than the 10% rate you can achieve on sale with business asset disposal relief. So it makes sense to take less salary and dividends from the business if these are going to be taxed at a higher rate. This will mean the company's cash balance will be higher at the point of sale, and care needs to be taken that it's not so much that HMRC no longer consider the company a trading company and the relief is lost. However, it's also important to remember that some dividend income is taxed at 7.5% and can represent a tax saving over the rate you get on sale. So it's well worth engaging in some tax planning in your final years of ownership to make sure you optimise your takings so that you're paying the lowest rate of tax overall on your lifetime earnings. Let's go back to Tim to tell us more about the next step, which is the legal process and some of the key documents involved.
Thank you, Atif. So I'm going to give you a quick flavour here, as some of these documents have been mentioned already. But the first document, as Paul says, you've shaken hands with your buyer, memorandum has been agreed, heads of terms are ready and are typically one of the first documents signed. I'm often asked, are they legally binding? And generally speaking, they're not. What Paul and his team will normally do is issue the memorandum of sale, which sets out the key terms in terms of parties, price, timelines, and so forth. But that of itself isn't a legally binding document. It's usually combined, as Paul has mentioned, with the initial deposit form, and that's pretty much a standard requirement that we tend to see on transactions nowadays. As Paul mentions, it's usually a deposit paid held by your solicitor as the vendor in return for giving the buyer a period of exclusivity to get to the point of exchange of contracts. And I've mentioned the merits of split exchange and completion, and I'll mention this one in passing as well. The actual contract of sale can take one of two forms, and I suppose a good contrast would be when you sell a property and you're moving home. What usually happens is you exchange contracts, and then 10 days or so later you complete and you have to move. And you can sell your company or your business that way and effectively have a gap between signing and completion. There is a key difference though to when you sell a house, which is that with a business transfer, the fact that you've exchanged contracts doesn't guarantee a completion. There's usually a list of conditions to be met before either party have to proceed to the final completion. So in my experience, most buyers and sellers tend to prefer the slightly more straightforward alternative, which is the upfront deposit, the exclusivity, and then you simply sign the contract on the completion day and you proceed in that way. I mentioned commitment letters. These are really only relevant on asset sales. It links to the point Paul makes around the merits of on an asset sale where you need NHS consent, ensuring that the buyer makes that application right at the start. There is an issue around that application going in before any legal commitment for the transaction has arisen, because the application is the buyer's application, and once the consent is granted, what you don't as the seller want to find is that the NHS reflect the fact that there's been a transfer of the business before legal completion's actually taken place and you've been paid. But that can generally be resolved and protected fairly simply by the use of a commitment letter that the buyer signs, essentially confirming that it won't notify any transfer date to the NHS without the agreement of your solicitor. Paul has also mentioned NDAs. We often find that there's an NDA or a confidentiality agreement also signed at the beginning of the legal process, which confirms the integrity of the due diligence information and again protects the fact that you're, as a vendor, intending to sell so that you can control the circumstances in which that becomes generally known. Due diligence we've talked about, which is a key part of the process. The sale agreement I've mentioned is a key document, and I'll come back to the ingredients of that briefly in a minute. There are likely to be some property transaction documents and possibly some consents that sit around those, so a lease transfer or possibly the grant of a new lease. If your business is mortgaged, those mortgages will need to be released at the point of completion, so there may be some documentation around that, which your lawyer should be able to deal with for you. And finally, as I've mentioned before, if it's an asset sale, so a change in the operator of the business, a staff consultation process will also be needed. Key ingredients in the sale contract, I'm going to list these, but I won't dwell on them in too much depth. Again, this is a subject almost in its own right. But obviously price is usually top of the list, and there'll be a headline price for the business, which is its goodwill and the value of its fixed assets. And alongside that, if it's an asset sale, there'll be a payment for the value of stock. And if it's a company sale, there will be a payment for net asset value, which is based on a set of completion accounts, which I won't dwell on because Atif's going to come back to that in a moment. So part of the price may well be payable after completion, particularly on a company sale where you've got net assets to be verified by the completion accounts after the sale's gone through. So you may, as the vendor, want to think about some security for that if that's forecast to be a fairly substantial amount. Maybe a payment on account from the purchaser, or the purchaser lodging some money in a joint solicitor account. We've seen that quite commonly. On an asset sale, it's worth giving some thought to what assets and liabilities are sold and retained. But essentially, what you will be selling as the vendor is the goodwill, the NHS contract, your stock and your fixed assets. You'll transfer your commercial agreements and your staff, and you'll retain your cash, your debtors, your creditors and your liabilities. On a company sale, there'll be something called a tax covenant, which is essentially a provision that says if there's any liability to pay tax within your company at the point of sale that hasn't been paid and isn't taken into account in the share price, then that remains your payment responsibility, and that's quite a normal provision. There'll be some warranties in the documentation around the business and its historic performance and possibly tax if it's a company sale. And those should be carefully checked through your solicitors, as that's your main area of risk, and you'll want peace of mind that you've made any relevant disclosures there so that you're not exposed to any claims after completion of sale. The purchaser quite commonly nowadays will ask to make something called a retention, which is where it holds back a proportion of the purchase price for a period of maybe a year or 18 months as a security in case it may have some claims. And it's pretty rare, to be honest, that we see claims, I think largely because vendors are quite careful to go through a thorough process. But a retention will often feature. The important thing is that if you are minded to agree one, it's important that the retention should be held by either your lawyer or possibly in a joint solicitor deposit account, rather than just simply retained by the purchaser. Again, for peace of mind, there's usually some limitations of liability around things like warranties for your benefit as vendor in the sale agreement. So you'd expect warranties to be time limited, normally around 18 months, unless they're tax relating, in which case it might be closer to 7 years, which is the typical liability period that HMRC enjoy. There should also be some limitations around how much you might be exposed to in terms of a warranty claim. If nothing else, the liability should be capped, so you're paying back no more than what you've received, although that would be a fairly doomsday-esque type scenario, but that ought to feature. And quite often there's a minimum claim value so that you're not bothered by trifling sums here or there from a purchaser. So those should all be ingredients within the sale contract that's negotiated. If you're resigning, then you'll be asked to sign a resignation letter. If you're staying on for a period and you're expecting to be paid, it's worth making sure that that arrangement is committed to writing as well. And then finally, you'll be asked to enter into some non-compete commitments. Essentially, if you're going to be paid for the goodwill value of the business, it's entirely normal that the purchaser can then expect you not to compete with that business for an agreed period of time post-sale. But those should be carefully checked, and you should make sure you've got a complete understanding of what you can and can't do after completion has gone through. So that's a very quick canter through from me on key ingredients, and I'm going to pass back to Atif.
Fantastic, thanks Tim. Now, as accountants, our job is to work alongside your legal team to go through the sale agreement with a fine-tooth comb. As Tim mentioned, in a share sale, the sale agreement sets out how the seller is to be paid for the net assets of the business, in addition to the payment for goodwill. Once the target date for completion has been agreed, we need to provide the buyer's side with a figure for the company's estimated net asset position at that date. This is made up of the company's assets, or things it owns or is owed, like cash, stock and debtors, minus the liabilities, things it owes out like money owed to suppliers or HMRC, but excluding fixed assets like equipment or shop fittings. Of course, we can't provide exact figures at this point because we'd need to wait to get statements from the NHS and suppliers, which won't be available till sometime after completion. So we estimate this as best we can, and this estimate gives the buyer an idea of the net current asset payment they will need to make in addition to the payment for the goodwill and fixed assets. Once completion accounts have been prepared and agreed by both parties several months down the line, a final payment can be made for the actual amount due as per the accounts. When we review sale agreements, there are a number of things we look at carefully. For example, the proposed method to calculate the net current asset figure, as this will affect your final payment. The agreement also sets out the terms by which the business must produce completion accounts, and what the procedure will be if the accounts are not agreed by the buyer. We also go through the tax warranties that Tim mentioned very carefully and cross-check them with the company's accounts and history for the last few years to produce a list of any facts and circumstances that need to be disclosed to the buyer. And these are then collated by your solicitor in the disclosure letter. You can see how important it is to engage accountants and solicitors who specialise in pharmacy sales to get this bit right. Because pharmacy is all they deal with and they see plenty of sale agreements in the course of their work, they know what's appropriate and what is excessive to warrant. And so having the right team of professional advisors behind you means you can benefit from their combined experience and you're able to more accurately limit your risk. When the buyers are happy with the results of the due diligence exercise and the sale agreement is close to being agreed by both parties, a target completion date is agreed for ownership of the company to transfer from you to the buyer. It's generally helpful if the completion date can be at a month end, as this makes it much easier to calculate the position at the point where the business is transferred. Let's go back over to Tim with a bit more on the legal completion.
Many thanks, Atif. So one of the questions I'm commonly asked is, at what point does legal completion of sale actually take place? And you might think it's an obvious answer, but it's one to be careful with. Essentially, it's the point at which the documentation is signed and delivered. And the point to be careful with is that very often the completion documents are signed by both parties in the run-up to completion and lodged so that they're ready on the completion day. And it's important to be careful with that and ensure that whenever you're signing any of the completion papers, that those are returned only to your solicitor, because there is a common law rule in English law that says that when someone signs and delivers a document, it's treated as complete. And what you don't want to find is that you've actually completed the documentation prior to the point that you expected to, and most importantly, prior to the point at which you've been paid for your business. Normally what will happen is that you will return the documentation to your lawyer will then sit on it and only exchange that paperwork with the buyer's solicitor under a series of legal undertakings, which are designed to ensure that the documentation isn't regarded as complete until the lawyers have had a phone call to agree that it should be dated and that legal completion has actually arisen. There is one other point to bear in mind. With an asset sale, where NHS consent is needed for the transfer, it's important to link the completion date to the date on which the NHS amends its pharmaceutical list to include the buyer in the place of the seller in relation to ownership of the NHS contract. It's important to coincide that with legal completion for obvious reasons. The seller won't want to find that it is no longer the legal owner of the key asset, namely the NHS contract, prior to being paid, and the purchaser won't want to find that it is the registered operator of the pharmacy with the NHS prior to the point that it's expecting to take over day-to-day running of the business. So that's an important linkage point. The other point that I was going to mention very briefly was around timing for payment of the sale price, which is something that we briefly touched on. But essentially the headline price for the business, which is the fixed assets and the goodwill, whether it's a share sale or an asset sale, should be paid at completion. There may or may not be a small retention made against that, as I've said. And then on an asset sale, the stock value is usually paid within 5 days or so of the stock value certificate coming through, which is after completion. And as Atif has mentioned, on a company sale, there will be the net asset value payment, which will be verified post-completion, but where you may decide to ask for a payment on account or a payment into escrow as a form of security if that's forecast to be fairly sizable. Back to Atif.
Thanks, Tim. Now, the next thing we need to consider is the completion accounts. These need to be prepared with extra care and attention to detail to make sure they're in line with the sale agreement and also represent the closing position of the company as accurately as possible, so that you can be sure you're benefiting from all your profits from your period of ownership of the business without paying for any of the business expenses from after this date. Once the accounts are prepared on this basis, they're sent to the buyer's accountants, and under the terms of the sale agreement, they have a specified period of time in which to inform us of any disputes or to accept the accounts. After reviewing the accounts, the buyer's accountants will either accept them or send a list of any items they believe should be included or removed from the accounts. For example, payments made by the company after completion that they believe were incurred before completion. We would go through any points of dispute and try to agree them with the buyers, and once the accounts have been agreed, we'd revise them accordingly so that they're accepted by both parties. The buyer will then release the final balancing payment for the net current assets, which means you've now received full payment for your business. Now back over to Tim to tell us about some of the things he's seen coming up on his side.
Thanks, Atif. Yeah, so I thought I'd mention a few points, the first of which being rather topical. I'm sure everyone will be familiar with COVID Advance Payment Scheme, which has been with us since March this year, and is essentially the cash flow support that the government has been making available to pharmacy operators in England and Wales. One of the key questions I'm often asked, whether it's on an asset transaction or a share sale, is how they should be accounted for, who gets to keep them, those sorts of questions. So generally speaking, we've seen two approaches here. The first is that the seller is essentially able to keep any COVID support payments that it may have received up to the point of completion, and that the buyer can retain those that are paid after completion. And in terms of any repayment liability attaching to those, that basically tracks whoever has retained the funding in question. The alternative approach, which we've started to see more recently, is that the seller is asked to lodge with its lawyer all of the COVID payments that it's received in the run-up to completion. The buyer does the same for those received afterwards, and they're put into a pot. And at a future point, typically 6 months, maybe down the track, the total payments are looked at in the round, and there's a process to agree the best and fairest way to split the total payment between both parties. Obviously, with again the related commitment that if there's a repayment call made on those funds down the track, the party that keeps each proportion is then responsible for any repayment commitment on that proportion. There are obviously some unknowns though still at the moment in terms of will the NHS ever look to recover these payments? They say they will, but your guess is as good as mine. But certainly that possibility is being provided for in documentation. And the other question, of course, is how the NHS would recover those payments. I mean, if the payment's been made to a contractor who has since retired and done an asset sale, on what basis is the NHS going to come back to that contractor and ask for the money back? A number of people that I've spoken to take the view it's more likely that the NHS may look to recover the value of that grant funding, essentially, through adjusting tariff rates, a bit like the category M repricing arrangements that we typically see going in cycles. Again, that's not entirely clear how that can work because the funding's not been characterised as a payment for services, but as a cash flow payment. So there are some unknowns there, but that's certainly how we're seeing the issue play out at the moment in terms of transactions. Atif mentioned briefly earlier vendor loan account balances. This is only really relevant on a company sale, a share sale. So you may have a company which at the point of completion owes money to its shareholders. So its shareholders are a creditor of the company in the balance sheet at completion. The point for the vendor is to ensure that if it's owed money by its company, that the company will actually pay that money once the company changes hands. So very often we'll want to ensure that any loan balances owing in that direction are repaid at the point of completion. And the corollary to that is that if the sellers, the vendors, owe money to their own company, then they're a debtor in the company's balance sheet, and the buyer will want to ensure that that debtor is repaid out of the sale proceeds at the point of completion. So that will be the normal treatment within the sale documentation for those sorts of balances. And then the final point for me here, again, links back to a point Atif was making. It may well be that there are some substantial cash reserves within the company on its balance sheet at the point of completion, particularly if maybe it's sold an asset in the past, or if the shareholders have been taking a reduced level of dividend or salary in the run up to completion. And we are from time to time faced with purchasers who feel that they don't want to pay essentially cash for cash where there are substantial reserves that are built up. And quite often purchasers will encourage vendors to take a pre-completion dividend to reduce cash reserves down to a level that's more aligned with normalised working capital. The issue there, of course, is that if the vendor does so, that would be a dividend, and if they're high rate taxpayers, there's a 38% dividend tax charge, so it could be a substantial tax cost. If, for example, there was, say, £50,000 worth of spare cash on the balance sheet, that would be nearly £20,000 worth of tax. In our experience, though, it's quite possible to convince purchasers not to be down that pathway, even if there is quite a bit of cash on the balance sheet over and above working capital. Ultimately, there's no cash flow cost for the buyer in paying cash for cash because it's self-financing. There is potentially a very small tax charge for the purchaser, 0.5% of whatever tax is there as stamp tax. And where there are substantial payments involved, we tend to find that buyers can be convinced to pay cash for cash and enable the vendors to take that cash out as part of the share sale price. And obviously, if it's entrepreneurs rate relieved, that's a 10% tax charge. So if the spare cash was 50 grand, the tax bill would be £5,000 rather than 20. So it's a bit of a no-brainer from the vendor's perspective. It's a bit of an explanation of winning hearts and minds with the buyer, but certainly not a difficulty that we've experienced in practice that can't be resolved just with some conversation. So hopefully that's a few useful thoughts around that, and I'll pass back again to Atif.
Great, thank you, Tim. So we've gone through completion, we've gone through the completion accounts. Let's talk about what happens after completion. The final step is declaring the sale on your personal tax return and calculating and paying the tax due. The sale will fall in the tax year ending 5th of April and would need to be reported in your tax return for that year. This would need to be submitted and the tax paid by the 31st of January the following year. As an example, if you sold your business on the 1st of June 2020, this would fall in the 2020/2021 tax year, and your tax return and payment would be due to HMRC by the 31st of January 2022. In terms of the actual tax that would be due, if you received a total of £1 million for your business and its assets and paid professional fees of £50,000, your total gains from the sale would be £950,000. And the capital gains tax due on this after the application of your annual allowance and business asset disposal relief would be just under £94,000. Once we calculate your tax bill, we can also advise you on ways that you could reduce it. Another important area you'll need to look at is estate planning, which Tim will briefly talk about now.
Thanks, Atif. So neatly segueing into the territory of a private client lawyer. Just a few points really to flag here, and I'm not going to dwell on it at length. But I've always regarded it as a matter of good housekeeping on completion, just to remind vendors to think about powers of attorney and wills for peace of mind and tax planning. Powers of attorney, just a reminder that new rules came in on this a few years ago. There are now two standard forms of powers of attorney. There's a health power of attorney and a financial power of attorney. They're standard forms that you have to fill in. They're issued by the Office of the Public Guardian. Your lawyer will normally be involved in helping you prepare and sign off on those forms. A reminder that they have to be registered with the Office of the Public Guardian to be fully effective. That's a key point, so don't just sign them and leave them in the drawer. And in terms of wills, these are key. I'm sure everyone will know that the key purpose of a will is to ensure the efficient administration of your estate, and that your estate can be dealt with appropriate speed in a tax efficient way, and most importantly, that your estate passes ultimately to the beneficiaries that you intend. And the issue, if you don't leave a valid will, is that you're reliant on a set of very antiquated intestacy rules under English law, which mean that the administration of your estate is much slower. You won't necessarily have the opportunity to gain some good tax efficiencies. And the way that the antiquated rules work means that you may even find your estate isn't divided between your beneficiaries in the way that you would want. So if nothing else, the key takeaway there is to remember to make sure you have both in place. Indeed, you should have both in place, even if you're not about to complete the sale of a business, as anyone who has assets of value should be considering those just as a matter of sensible planning. Back to Atif.
Thank you again, Tim. Some very helpful and very important points there. While we're on the subject of things to talk about after the sale, it's also worth considering your exposure to inheritance tax, or IHT. When you own your business, you benefit from business property relief, or BPR, which means if you were to die, the business assets would be outside of the scope of IHT. But once the business is sold, BPR no longer applies, and your share of the cash proceeds would be liable to IHT if you were to pass away unexpectedly. We also advise all our clients to talk to an independent financial advisor who can guide you on investments you can make for a tax-efficient income in retirement. And apart from that, the final thing to think about, you just need to decide what to spend the rest of your money on. That's all from us today for the presentation. Thanks everyone for joining us and listening, and we hope you found it informative and it's given you something to think about. We've had some great questions coming through while we've been talking, so we're going to look at what we can in the time that we've got remaining. First question we've got in here is in relation to the COVID advance payments and rate relief that we've seen in this year. And one of our listeners has asked, how does this impact the valuation and how should this be presented in business accounts? So I think that's one for Paul and I. From an accounting point of view, as Tim talked a bit about the advance payments, there is some uncertainty here in terms of what is actually going to happen in the future and whether these payments will be recoverable. But certainly what we're being told at the moment is that these are just advance payments, the money will come back. And so at the moment, it doesn't make sense to recognise them as income in the accounts because there is every chance we're going to need to pay them back. That is something we hope will change in the future, and we do hope this money won't be clawed back from pharmacies. But if that's the case, once it's confirmed, it would be appropriate then to recognise it as income. The situation with the rates relief is much simpler, and we can recognise that in the accounts because it is something we know we're not going to pay back. Paul, have you got any comments on the valuation side?
Thanks, Atif. Yeah, I think, as you sort of say, it's not something which is necessarily ongoing. So I think, as I say, we take the view that you've got to discount it for valuation purposes. In a nutshell, really, I think I understand in Wales they are starting to recoup some of those payments now. So whether or not that will come across to the rest of the country obviously remains to be seen. But as I say, yeah, from valuation purposes, I think we do need to discount it. As you say, it's not perceived as ongoing income at the moment. If that changes, possibly take another look at that. But yeah, no changes on valuation at the moment.
That's great, thank you, Paul. Another question we've had come in, I think this one's for Tim. It says, I have 12 years left on my lease. Do you think that this needs extending?
Well, that's a good question. Paul's probably got a take on this too. I mean, in my experience, most purchasers would accept 12 years, particularly if it's a renewable lease or you had some sort of first refusal to buy the freehold of the landlord's building. You might be particularly unlucky and find you've got a buyer who's taking 15-year finance, but I wouldn't be rushing to to worry about addressing it. In my experience, 12 years should pass muster if it's a renewable lease.
I'd say really the sort of crucial point is when you're planning to come to the market. I think if you were to say, okay, well, I'm planning to sell in a couple of years' time, then you're then looking at least below sort of 10 years. Feedback that we've had from lenders and finance brokers is that there are a lot of lenders out there that just aren't sort of comfortable with those sort of lower leases. And I think, as I mentioned, when you have sort of first-time buyers applying for finance, let's say that loan will be sort of matched to usually to the term of the lease. When it goes below 10 years, it starts to those repayments start to mount up. So I mean, generally speaking, as Tim sort of said, that should be okay. But I think if you were sort of planning to come to the market soon, but yeah, if it's a sale, maybe you're not planning for 3, 4, 5 years, then I think that's something to consider and look at closer.
That's great. Thank you both. Really good answers from both of you there. Right, another question we've got in for Paul, I think this one is, it's when do you advise I inform staff about a sale?
It's a good question. It's something which we come across quite a lot. A lot of sellers, it's something they don't necessarily look forward to doing. They're sort of worried about either losing staff or upsetting staff. My sort of response tends to be, well, you've got to be, your staff. You should sort of obviously consider their reaction and how they might sort of take the news. I think in most situations, the feedback that we've had from clients is that once they do disclose the sale to staff, it's sort of a weight off their shoulders, and the staff are quite often very supportive of their decision. In terms of sort of timing, though, it's we've sort of seen scenarios where clients have, as they go to the market, they decided to tell their staff at that point. And then we've seen the opposite, where staff have been informed on the day of completion, which hasn't always, understandably, gone down very, very, very well. So, we would sort of certainly recommend that the sale advances certainly somewhere along, and there's confidence that the sale is going to proceed. Obviously, there could be some legal matters involved, which obviously Tim will sort of comment on that. But I would sort of usually sort of say, yes, wait until the sale sort of quite advanced before you have that sort of discussion. And
yeah, just to add to that. So I mean, I agree with all of that. If you're selling the business as an asset sale, so there's a change of employer, I mentioned there is a legal process that you have to follow. That process doesn't stipulate an exact definition of how soon prior to the sale the staff must be consulted with. It's just simply stipulated as being a reasonable time. I kind of take the view that as long as you're comfortable the buyer's not going to be making any changes to working arrangements, then a minimum of 2 weeks maybe is a safe margin, just to allow for.
I think our sort of recommendation as well is that perhaps a way to manage that sort of discussion is to break the news to the staff and have the new owner perhaps have it arranged that they come into the pharmacy perhaps the following day or a couple of days later. Because naturally the staff will, they might have sort of questions or have concerns. So I think it's quite a nice way to handle that process, that the new income owner arranges to come in and meet them and just hopefully put their minds at rest and answer any questions that may have.
Great, thank you guys. Another question's coming, this one's for Tim, I think. It says, you mentioned about deposits. Are they guaranteed and non-refundable?
Oh, that's a good question. It depends whether you're using the Hutchings form. That's the answer I'm required to give. That joking aside, I mean, it does depend on what the terms say, but market practice is not to treat the security deposit as a fully non-refundable deposit, come hell or high water, because that's not really the purpose. It's really designed to, test the water on, the purchaser's commitment to seeing through the transaction that it's shaken hands with you on. Mm. Obviously, if the buyer withdraws with no good reason at all, then you'd expect the deposit to be forfeit. Mm. And I tend to say to clients, if I'm acting for buyers, that you should regard the deposit at risk if you simply can't get the bank funding on the terms you were expecting, as opposed to, if there was an issue with the business and the bank wouldn't lend on it, which is a different matter. Mm-hmm. So I would really regard it as probably not much stronger than that, but still very much worthwhile having. Because what you don't want to find is that you put your eggs in one buyer's basket and they're not really serious. And I'm sure Paul would say the same thing, that it's a good test of the water on their commitment to the deal.
Absolutely. I think, the idea is not to keep the deposit. The idea is to complete on the sale. But Sim said it's an early test of sort of commitment to the process. And certainly, that's the sort of key objective to get the sale over the line to speak for and progress forwards on that sort of basis. It's not about sort of keeping that deposit, but just seeing that commitment from the buyer overall.
Great, thank you both. Right, I think we've got a little bit more time, so we might be able to squeeze in one or two more questions. We've just had one come through as we're doing the Q&A, and someone's asked, following a little chat about the advance payments, they've asked, where do you actually put the COVID advance payments then in accounts? So that's a quick one to answer. I mean, essentially at the moment, looking at these as a cash flow advance that needs to be paid back, we would treat it very much as a loan, and it would sit as a liability in the company's balance sheet, showing we've received the money, but also that we are going to need to pay it back at some point. We've got another one here, and this one is a bit of a legal one, so maybe one for Tim and Paul, just asking, in a company sale, can I complete mid-month?
Well, that's another common question and a good one. Probably one for all three of us.
Yeah.
Legally, you can complete on any day of the month. In practical terms, it's quite common to complete at the end of the month, simply so that Atif doesn't have a complete brain stretch on the completion accounts, because obviously on a monthly accounting basis, it's easier to work out, income and overhead costs.
Absolutely.
But I'm sure you've got thoughts on that as well, Atif.
No, I mean, to be honest, I would very much echo that. We do normally encourage people to complete at the end of the start of the month, because it does make things a lot easier from an accounting point of view. We very often, or we do sometimes see a situation where we need to complete mid-month for various reasons, and it's something that can be done. I think what's really important is kind of being prepared for that, and the buyer and the seller agreeing how that's going to be dealt with from an accounting point of view, so that when you do your completion accounts, you're more likely to get an agreement rather than a lot of arguing about how things have been split over the periods.
I think from a sales perspective, I'll probably come from a slightly different viewpoint on that. I mean, we're kind of, as we obviously understand that, there's accounting and sort of legal procedures to adhere to, and quite often needs an end of month sort of completion. However, if all parties in agreement and are willing and able to do so, then from our perspective, complete sale. Get it done, but I appreciate obviously then there's as I say, all other considerations to take into.
I suppose the other point is to make sure your stock taker is free to do it.
Yeah, that's true.
Because you don't have to have your stock take on exactly the day of completion, but you kind of need it a few days either side, because there's a limit to how they can adjust the count.
Yes.
Yeah.
Absolutely.
Great, thank you everyone. Right, well, I'm afraid that's all we've got time for today, but thank you again for joining us. Thank you again for listening, and good night.
Good night.
Good night.